Simon, thanks for letting us barge into your lobby, which is beautiful here. And we just had a look around your offices. It's a really nice spot. So we won't take up a huge amount of your time, but I think the best place to actually start is with a bit of a 101. So just remind us, PFI, what it looks like today, how big you are, what's the asset base look like? Let's start with that.
Yeah, thanks for coming in, Mo. It's always a pleasure to show off where we work. I guess if you look at PFI today, you probably have to take a step back and understand how we've got here. So PFI is a listed property company on the NZX. We've been here, or been around for 30 years now, something we're quite proud of, one of the longest listed companies. We focus solely on industrial property. We've got a portfolio of 91 properties as at June this year, valued at $2.2 billion. We lease those properties to 126 tenants. With a weighted average lease term. So the average lease term across that portfolio is about 5.5 years. So predominantly based here in Auckland, 87% of our assets are here in Auckland, and then the balance in and around the country, including a large estate down by the Port of Tauranga in Mount Maunganui there. So that's the portfolio in short, really.
Yeah, and so Auckland based and very much industrial focused. If I'm a potential investor, why do I like those two things in particular?
I think Auckland as a focus, it's the largest city in New Zealand, so majority of the population is based here. We see it as the deepest and strongest market from that point of view. One of the other key things we like about Auckland is the scarcity of land. So if you look at how Auckland is developed out, you've got two harbours either side, a narrow piece of land, so land is in short supply. And PFI, because we have been around for 30 years, we own a lot of great sites in the central part of Auckland, so you have real growth when it comes to rents, which is important. Scarcity drives rental growth. And
the population growth here must be stronger than other parts of the country?
Yeah, currently it's probably going the other way, which is a bit of an anomaly. But yeah, traditionally Auckland leads the country in terms of population growth, which is good. The other key reason we like about industrial property is the scale of the assets. So our average lot size is about $20 million or just under $20 million. So we consider that quite liquid. So you can buy in and out at that size quite quickly when you compare it to, say, office towers or shopping centres.
And what you mean by that is the potential buyers and sellers in that pool are quite a lot more than someone trying to buy a hundreds of $1 million worth of office tower.
Yeah, exactly right. Yeah. So if you want to divest an asset, there's more people that can buy that asset. I guess the other key part of why we like industrial, and we switched about, it would be 6 years ago, we came out with a strategy to go pure industrial, is the ongoing capital requirements or maintenance requirements. So if you think about a warehouse, which is what we typically own, it tends to be made out of concrete and steel. Single level offices, generally smaller offices, so you're not paying big money towards air conditioning or lifts or tenant fit out. So you tend to build these assets and they last a long time, 50 years plus. So you don't have ongoing capital requirements, which is to the extent that you do an office or retail perhaps.
Yeah, right. So the Reserve Bank made all of us pretty happy, particularly those with a mortgage, and cut interest rates again. And we're looking at I think an OCR of 2.5% now. Big move down from the peaks. What does that mean for your business? That must be a reasonably big deal. How does that flow through mechanically for PFI?
Yeah, well, I think it's nearly 300 basis points from the heights in August 2024. So it's been aggressive cutting as well as what I would say over the last 12, 15 months. For us, interest is our biggest cost. So it's something we track intimately, obviously. And as that cost of finance comes down, it gives us more of a gap between the money that we earn in from our properties, the portfolio yield, to what we're paying out to the banks. So it's a big moment for us. And it's part of, I guess, of how we see our dividends continuing to grow over the next couple of years, which is really pleasing.
Yeah, and that falling interest rates, because it's happened so recently, it probably hasn't completely worked through your business. It'll take a bit of time, just like it will for those that have a mortgage locked in for a while, until they refix.
Yeah, we have certain portions of our debt that is fixed, so as that rolls off, we still have an element of floating debt though, so that flows through immediately.
Right.
It also is a big help for our tenants, and we'll talk about that shortly, but for the tenants, the cost of finance coming back is obviously, will be enhancing their ability to invest in their own businesses. So we think it's a really good move by the Reserve Bank.
At the start, you mentioned in that sort of, setting the scene, I think you said over 120 tenants, which is huge. That's 120 different businesses that you have some touch point with. So, when you talk to them, how do you think they're feeling about the economy, and give us your own view as well. How do you feel about it now with those big interest rates cut coming through? Are you seeing some green shoots? Are your businesses or your tenants seeing some of that as well?
Yeah, so 12 months ago we thought 2025 year end would be a tough year, and we anticipated probably losing one or two tenants. Pleasingly, we got through really well. We actually had quite a strong year last year, which was pleasing. There was that survive to 25 and keep going to 26.
Yeah.
I think there's still probably another 12 months of tough times out there.
Right.
As you say, 126 tenants. A lot of them, the middle part are probably just surviving is how I'd describe it. We've got some that are doing really well, and then some that are doing it tough. So those interest rate cuts, I think you'll start to flow through towards the end of this year, start of next year. But I think the economy was crying out for it, really.
Yeah.
So it's tough out there is what I'd say.
You're a big landlord, industrial landlord, focused in Auckland, sort of $2 billion plus of assets, but I imagine there's some development going on at any point in time across those 90 odd assets as well. So what does that pipeline look like, and how do you decide how much of the portfolio, I guess, you're developing at any point in time?
Yeah, so about 3 years ago, we sat down and we ran through our portfolio and we looked at assets sites that we already owned that would be right for development in the medium term. So for us, that's 5, 6, 7 years out. And we kicked off a redevelopment program on 3 sites. So in the last 3 years, we've developed over $200 million of high quality brand new assets, which are all leased really well.
And so just on that, so that's from existing sort of assets you already own?
Yeah, so properties that we've owned, and I'm thinking in particular one in Mount Wellington, Bowden Road.
Yeah.
It's an asset that was built in the 1960s that had got to the end of its useful lifetime. The tenant had moved out. We had a 2-year runway before they moved out, so we were able to do all the planning. We were able to secure a tenant before we started building, which was really important.
Right. And
we committed to a new build, which has been really successful for us. Looking forward, we've still got, it's about $300 million of those types of assets, which over the next 5 to 7 years we'll get access to, and if the market's right, we'll redevelop.
Yeah.
But for the first time, we've also secured some land. So Spedding Road, which is northwest of Auckland here, opposite Costco up in Whenuapai. We've got 6 hectares of land that we're due to settle on towards the end of this year or the start of next year, and we'll be developing a portion of that, stage 1 of that, from February next year. So again, that's a capital spend on the land of circa $40 million, and then each stage will, the first stage is about $35 million. So we've got a runway there where we can, bring these assets into the portfolio.
Yeah. And are you controlling a lot of that in-house? Is the development or the design, is that done in-house, or do you put that out to a third party? And also, construction costs is sort of front of mind for everybody. Has that changed at all over the last 4 or 5 years?
Yeah, so to answer the first question, we have a development team in-house.
Yeah.
We outsource the architecture work and the engineering work and the construction work, but we have development managers in-house, which is an important factor for us. And it's a team we've built up over the last 3 years, and it allows us to push on with this program. In terms of construction costs, from the peak, which is 2-3 years ago, to now, the construction costs have come back.
Yeah.
I think there's been plenty of articles out there around how there are no cranes in the Auckland skyline at the moment. So it is tough at the moment for the construction guys. Having some development projects on the go at the moment. We've got stage 2 out at Springs Road, and construction at the moment has meant that we've benefited from a reduction in construction costs.
Yeah.
And that will obviously flow through to the bottom line for those particular developments and be beneficial to our shareholders.
But you're not necessarily trying to time that. You're more of there's just a staged process, and at the moment you're just benefiting as that cycle goes through.
Yeah, if you look at our portfolio, $2.2 billion, we'd probably always like to have between 5 and 15%, in a development phase. So at the moment, about 5% of our assets are under development.
Yeah.
So it's sort of the cream on the top. The core generic stuff that we own, that collects the rent every month on an annual basis, which is pleasing. And then you add the cream on the top, I guess, through development. Someone
uninitiated in industrial property like me drives down the road, it's just a big shed, which is probably quite attractive to you. But has much changed over the years? You're doing these new developments. Is a shed still a shed? Like, what's different from, say, 10, 15 years ago? Because certainly housing, offices, they look quite different to probably what they did 2 decades ago. Has much changed in the industrial space? Yeah, I think the key factor, particularly in Auckland, is that scarcity of land. So 20 years ago, when you were developing, the land portion of your development was very cheap. And so people would buy big
big lots, big sections, and you would put the building in the middle and you wouldn't maximise site coverage because you didn't have to, because land was $150, $200 a square metre. With that growth in Auckland now, so land prices are around that $1,000 a square metre. So you have to really maximise your land coverage. And one way of doing that is height. So 20 years ago, your warehouse would be built to about 8 metres.
Right.
Now, the sheds we're building now at the peak is 16 metres. So it's almost double the height, which allows you to store more cubic volume in these buildings.
So that you're basically wrecking twice as high.
Exactly right.
Yeah.
So tenants, particularly in the logistics space, are looking at how many pallets can I store on a site. So 20 years ago, you would have big buildings that sort of expanded out.
Yeah.
Now it tends to be going up. So that's a big part. The other big change, I guess, not just in industrial, but across development in the last 5 to 7 years, I guess, is the sustainability factor.
Yes.
So all major projects that we undertake now have a Green Star rating. 5 is what we're targeting. So things like solar, rainwater harvesting, separating out trucks from passenger vehicles, lighting within the warehouse, these sorts of things, are now become standard design, which is a good thing.
And is that just tenants expect that now? It's not necessarily getting you more rents, but it's kind of the base expectation of new tenants?
Yeah, what we've seen is the large international tenants have been pushing it.
Yeah.
And now what you've seen is the bigger landlords, the better landlords are taking the charge really and doing it by delivering that as a standard spec really. So you are starting to see a little separation in terms of the rents you'll get. It's not material yet, but I think in the next 5 to 10 years, as banking regulations change, insurance requirements change, you'll start to see a premium. You're seeing the premium already in the office space, and you'll start to see it in the warehouse or the industrial space.
And out of curiosity, and I think in Asia you're seeing it a little bit as multi-storey industrial sites.
Yeah.
Do you think New Zealand will ever get there? I mean, never say never, but is that sort of on the horizon that we could get to a multi-storey?
Yeah, we've seen it a little bit come into Sydney now, particularly the inner west. So again, that's a function of cost, the cost of land and how rents have tracked in those tightly held areas. Whether we'll see it in New Zealand in the next 5 years, I have my doubts, but what you are seeing is some 20 to 25 metre stud buildings being constructed. There's 1 or 2 out there in Auckland, but with automation. So rather than multi-levels, you're having robots driving the racking system. So again, as a function of efficiency, how do you maximise these sites? You're starting to see that. It'll take a while before it's standard here in Auckland, though.
Yeah. And that land cost, clearly it's right across the board, whether it's residential, whether it's office, whether it's retail or industrial. So you talked about redeveloping existing sites. You didn't mention acquisitions much. Is that kind of off the table because there's just not many out there and the prices are just too high? Like where does that sit in terms of redeveloping existing sites versus going out and just cutting a check?
Yeah. So if you look at, particularly in the last couple of years, from our point of view, you have capital that you want to invest, and where's the best returns for that? So the last couple of years when interest rates have been very high, investing in our own portfolio has made money for the business.
Right.
With interest rates falling away, we can secure finance now below 5% all in. So if assets are on the market at 5.5%, 6%, there is now an argument for getting back into the acquisition market. So we evaluate where does our capital best be placed.
Yeah.
The most recent acquisitions, and we've bought 3 properties in the last sort of 18 months, have all been what we call a bolt-on acquisition. So they're neighbouring properties of estates that we already own, and so we try to increase our footprint. So we've been prepared to buy through that period. But in terms of looking forward, I think you'll see the market starting to pick up. There's already been more activity in the acquisition space, and we will be back in the market at some point.
So you guys are a bit like the farmers. You just buy the neighbouring farm. You just buy the neighbouring industrial property if you can get a hold of it.
Yeah, we're always interested in neighbouring properties, and we had a lot of success in that in the past, particularly because the portfolio has been around for 30 years. We've got large land holdings in key Auckland precincts like Mount Wellington, Avondale, Rosebank Road Peninsula, Penrose. So there is some synergies that you can build if you can own the properties side by side.
And it makes you the logical buyer, doesn't it, if you can just increase your size?
We're pretty disciplined in how we do it. It needs to, just because it's next door doesn't necessarily mean it adds value, but where it does, Nelson Street and Penrose, we've bought multiple properties adjacent, which when we come to redevelop that site will mean that we control the easements, control the driveways, that sort of thing. So it does add value,
Now, listed property, one of the big attractions is sustainable sort of dividends, reliable income streams. Investors love that about, and reasonably tax efficient. So if I think about the puzzle that you have to solve every year, it's kind of dividends, debt, and developments, right? So
Yeah.
there's those three factors. How do you solve that to kind of meet all the needs? You want to have a good growing dividend, but you need developments to do that, and you need to look after your balance sheet and your debt level. So how do you think about those kind of playing into each other?
Yeah, well, like I said, PFI has been around for 30 years. Pleasingly, if you read the annual report we put out earlier this year, on average for the last 30 years, we've delivered 9.35% total shareholder returns on an annualised basis. So we've got a real track record of delivering returns. Our dividend growth over the last the last 10 years has been just over 2%. So it is a real focus for us. One thing that we have done in recent years is we've pulled back our payout ratio. So that means we don't pay out every dollar that we earn, and that it just gives us a buffer. So if there is some moments where we're wanting to continue to grow that dividend, we can. The development piece is one part of it. We also, as I said, 85% of our assets are core generic, and so the asset management, the daily management of these assets, where we, go for rent reviews or keep the portfolio full. We're 100% occupied at the moment, so every day, every building is earning us $1, which is really good.
And is that unusual? Like, what's that been like in the last few years? Because it feels like we've had COVID, we've had basically a recession for a couple of years. It's been pretty dire, but you've almost been a little bit invincible in terms of how full the assets are.
Yeah, the industrial property market in Auckland in particular has had really high occupancy levels the last 5 to 10 years even, which is one of the reasons we like it. It comes back to that scarcity. But yeah, to be 99.9% is exceptional. It probably reflects really well on the team out the back here who are doing that work. We've got a real focus on cash flow, I guess is what I would say. So we're prepared to work with existing tenants to retain them. We like to do deals, get tenants in there, but yeah, the cash flow is the lifeblood of any company really, but particularly a dividend stock company. So
yeah, you mentioned the people out the back here, and I want to sort of focus on one partnership in particular, which is you and Craig Pearce, your CFO.
Yeah,
you've clearly got a secret sauce, and the two of you have worked together. Probably you'd be one of the longest serving pairings on the NZX now, and I don't want to sort of be ageist about that and say you guys are getting long in the tooth, but there's something there that works. So what is it that you guys sort of complement each other on? Where do you butt heads? How does that sort of come about that you seem to be doing very well? You're well liked by the market, and you come across as though you've got a pretty strong relationship. So is there a secret sauce you've got?
Secret sauce. Yeah, we've definitely been together a long time, it's fair to say. I think probably one of the key reasons why we have enjoyed working together for so long is we both started very young in the business when the business was small. So prior to PFI, we worked together and we took over the management business of PFI in about 2011. And at the time, PFI was just under $400 million of assets. So together we've managed to grow this business to $2.2 billion. Wow. So we understand how each other works. Yeah. I'm probably the optimist in the relationship, and Craig's the one that understands.
He's reining you back in a bit, is he?
Yeah, the realist, I think he'd describe himself as. But yeah, I mean, he's not only the CFO, he's the Chief Operating Officer as well. So he covers a wide brief within the company. But yeah, we're a small team. We're 25 people running $2.2 billion. So we like to think that we're doing small volume of transactions but very high value. So it allows us to spend time on each one of those and maximise potential value.
Okay. Yeah. And just thinking about tenure, coming back to you specifically, you've been in the role quite a long time as a listed CEO, which there's very few of obviously in New Zealand. What's it like sort of being listed? We sit on the other side, we ask you the hard questions and we complain about when you're not doing something we think is right or wrong. So is there a best and worst or best and most challenging part about being a listed CEO?
Yeah, so I took over as CEO in 2019, so coming up 6 years in the role. I think the best part is you get to operate at scale. It allows you to take on, projects of scale, such as development or acquisitions. So that's really important. It allows you to grow a team underneath you as you grow the business. You can bring people through. We've got really long tenure, not just Craig and I, the senior leadership team on average is close to 9 years in the business. So we've got a really strong culture here in the business, which is great.
And that's underestimated, I think, that tenure of people in the business who understand it.
Yeah, I think especially in property. Property is very much a long-term game, and it is a game we use the word, it's a game of inches. So you've got to try and, there's not great margins in development anymore, for instance. So you've got to try and maximise value at every step of the way through that cycle. In terms of the challenging parts of being listed, growing compliance, the cost of compliance, these are issues that, not just listed CEOs, but every business is, facing at the moment. So that's always going to be a challenge. We've always been an agile company, or known as a company that is agile and can move quickly. And with that increased compliance, sometimes that can, slow you down. So we're always fighting against compliance.
It's kind of you to say not sort of pain in the ass analysts like us asking you questions all the time. Hey, look, I won't take up any more of your time. This has been awesome, and thanks again for showing us around the offices. It's a great spot that you have here, and I think I'll go away with a little bit more of an appreciation of what's under that industrial shed, and I think we should take the opportunity to congratulate you on the performance that PFI has had recently and over the long term, and long may it continue.
Perfect. Thanks very much.
Thank you.
Cheers.